So in the first week was a very basic introduction to this module. I talked about what is macroeconomics, just defining what is macroeconomics, and to do that, I tried to explain what's economics and how that is related to macro and what we do in macro. Then it was natural to move on to what topics or what questions we ask in macroeconomics and what topics we will cover in this semester, on this course. Then I moved to some examples, looked at the global financial crisis, look at the main indicators, GDP growth, inflation rate, unemployment rate, etc., and how these indicators reflect the difficulties at that time during the financial crisis, and how different group of countries, advanced, emerging, etc., performed during the crisis. So that was a very good example of how important macroeconomic indicators are. And we started with the first and the most important one is GDP. So we started by, okay, we said GDP is just an indicator of how much output a given economy produces in a given period, could be a year or a quarter of a year. And then we covered how to calculate GDP. So let me share my screen and start looking at the first tutorial question, which is basically related to this same point, which is the, just a second. You should be able to see this now. I'm just going to disappear from the camera, so you're not going to see my face, but then you can see the question. Yeah, so now you can see the question. This is from last time. Sorry, I apologize. I'm going to just clean all of that. So don't worry about that now. We will get to that. So going back to what I was talking about here, I was talking about GDP, and this is something we started with last week, and we've basically started by explaining what is GDP. We explained that what GDP is the value of final goods. So basically, we think of final goods. That means we exclude intermediate goods, and we'll see an example today what that means and how important that is when you calculate GDP. Why is it important to exclude intermediate goods? And we also said, okay, we could, so this is one way of calculating GDP. So just look at the total, the value of final goods, or look at the value added. Then you basically just subtract the value of intermediate goods from output or from what we have produced. You could also look at incomes. So if you so when we talk about GDP, that means we can look at GDP. Let me just use a different color. That doesn't look great. When we look at GDP, so we said, okay, so there are three different ways of calculating GDP. So you could look at the final product or the final goods, or which means basically you actually just looking at the value added, okay? Or you could look at, we will see an example of that, what that means now, or you could or add up all incomes in a society. So we will talk about income, or we could be looking at the expenditure approach. So in terms of income, so there are different types of incomes in a society, or as a result of factors of production contributing to the production process. So you could have, so basically you add up any rent plus any profits, plus any, of course, wage, plus any interest. So you may call that in your introductory economics, you know that we have 4 factors of production, and these are land. So the return for land here contributing in the production process is, so that's land, and land here basically refer to all natural resources. So any natural resources, they have rent. When we talk about wage, obviously that's for labor. So, and that's when workers contribute to the production process, they have wage in return. And interest, that's the return on capital. And finally, the entrepreneurs who collect these factors of production, take the risk, and organize the production process, they receive profits. So these are the sort of incomes in an economy. And then if you add up all these incomes together, then that means you could end up, or you could have, or it's a different way of calculating how much GDP we have. The third method, which I briefly discussed, but we'll come back to this method again this week in the lecture recordings, and we will follow this next week in the next week tutorial. So basically, you could look at consumption plus investment. So basically, we look at consumption expenditures by households and investment by firms plus government spending plus X minus M, or net exports. So this term here refers to net exports, or exports minus imports. So this is your this is the interaction with the outside world. So this is another way of thinking of GDP, or calculating how much GDP is. So what we want to do today, we have two examples. Hopefully we'll have time to cover both. The first question we already covered now, so I already covered when I tried to summarize what we discussed in the lecture notes or in the lecture recordings last week. So that hopefully now that everyone understand that we can calculate calculate GDP in different ways, and these different methods should result in the same figure. If there are no omissions or measurement errors, they should return the same number for or the same value for GDP, because there are three different ways to the same thing. So to calculate the same thing. So it shouldn't be, they should not be different. So let's see an example in question 2. So that's basically the first question. And what is GDP? So GDP is the value of total or final goods produced in an economy in a given year. So basically, or a given period. And basically that means you exclude the value of intermediate goods. So you just focus on final goods. Okay, final goods and services. So just to be more specific, so we'll look at when I talk about final goods, I actually mean also including services as well. So moving to question 2. But before I start, do you have any questions? So just feel free to stop me at any point and ask your questions. Do you have any questions? You can type your questions in the chat, and I'll keep an eye on the chat, or you can use the mic to say your question. Any questions so far, guys? Okay, it's very quiet. And looking at the chat, I don't see any questions in the chat. So, okay, so I'll carry on. So moving to the second question, we have an economy where we have two companies, or two firms. Firm 1 is a silver mining company, where they just mine silver and they pay their workers. So let's say we have firm 1 that pays their worker, let's say W1 equal 200,000 pounds. So that's how much they pay to their workers, and they produce 75 pounds. That's 75 pounds of silver, which they sell for, of course, they sell to the second company here, the jewelry manufacturer. They sell that to them for, so sales from firm 1, it's 300,000. Oh, looks a bit funny. It was just 3. Okay, so the second firm, let's look at the second firm. So what does the second firm do? So the second firm, the jewelry manufacturer, pays its worker 250. So wages in that case for the second, so wage 2 equal 250. Okay, they make silver necklaces, which the manufacturer sells directly to consumers for 1 million pounds. Okay, so these are sales from firm 2 is for 1 million pound. Okay, so these numbers are in thousands, so that means 1,000 means 1 million pound. Okay, so the question now, how much is GDP? So assuming that these are the only companies, or these are all firms in a society, so how much GDP according to the final product approach? So, okay, and you have 10 seconds to tell me how much is that. You can use the mic or the chat box. Okay, let me have it. Yes, everyone is saying that's correct. Yes, that's perfect, because the final, that's true, because the final goods, or the value of final goods here and service, is 1 million pound, or 1,000, which is 1 million million pound. Okay, and that takes us to the main point here. Why did we not included the value of the sales from the first company? Because basically this value here, the 1 million pound, the silver necklaces, this value include already how much silver in it. So it includes already the 200,000, sorry, not the 200, the 300,000 pound of silver. So this is how much silver was. So it's 300,000 pound of silver that already included in the 1 million pound sales of silver necklaces here by company 2. Okay, so that's great. I'm very, very pleased to see that most of you already know how much the GDP should be in this case. So I guess that is a good indication that most people understand why this is the case, and why we should exclude, or why we should only consider final goods and services when we calculate GDP. Okay, so the next question then, so that is the first part of the question. Moving to the next question, we want to do the same, but you following the value added. Okay, so let's see how much is the value added. Let's start with firm 2 because it's more straightforward. Let's start with firm 2. How much the value added for firm 2? Can anyone tell me how much that should be? Okay, I'm just watching I'm looking at the chat. Okay, anyone would like to suggest how much exactly? So now that's right. I just want to see who. Yes, and Sabina, yes, that's correct. Why? Because that's true. Because now firm 2, they sold necklace or silver necklaces for 1 million. However, to make those necklaces, they bought silver from firm 2, which is worth 300,000. So that makes their contribution, or their value added, is 700,000. Okay. So how about firm 1? Firm 1, because we don't know, from what we have, the information we have is that firm 1 sold silver for 300,000. We don't know any. Let me have a look. What people say. That's exactly, and yeah, that's right. Yeah. So I'll come back to this wage point, but let me. Yes, that's right. So basically, firm 1, they sold silver for 300,000. However, we don't have any information about any intermediate goods that they used. Remember, how do we define intermediate goods? We define intermediate goods. Those are the goods that have been used, or that are used to produce other goods. So in our example here, silver made or mined by the first company is an intermediate good. Why? Because it's not sold directly to consumers. It has been sold, or it was sold to firm 2 to use it to make silver necklaces. So basically, silver here is an intermediate good. Okay. So when we think about the situation with the first firm, then we don't know if there's no information about anything they bought, or anything like intermediate good that they have used to produce the silver. So that means that was 0. So which means their value added is 300. Adding these together, that should give us the 1 million pound, which is exactly the same. So this one here, we use the final product or the value of final product. Here we just focused on the value added. Which should give me the same number. So now either you calculate GDP according to the value of final products approach, or you just added the value added, or you just counted the value added, you sum up all these together. That should give us 1 million, is exactly the same answer following the other approach. So is that clear? Okay, so in terms of why did we not consider wage? Because wage here is not an intermediate good, okay? Wage is just that's return on labor. Like this is how much workers receive in return for their production or their contribution to the production process. So that wage is not, or this service by workers isn't an intermediate good, okay? So an intermediate good, again, just a good or a product that has been used or that is used to produce other products, okay? Okay, so let me just, okay, let me move on to the next point now. So if that's how much the GDP is following this approach. So let me just clean this, just make some space for us. Okay, so let's move to the next point. So if this is the how much is the GDP according to value added approach, so how much would that be if I'm going to consider income approach? So I'm going to add up all incomes in this society or in this economy. So assuming that these are the only firms in this economy, and we know that firm one pays 200,000 for wages. So basically, I could just add wages. So wages will be that wages. So firm one pays 200,000 plus firm two pays 250,000. So that would give us 450,000 paid in this economy as wages. Okay. So what else we could get from here? What type of income we can calculate from here is profit. So basically, we know how much each one of those firms, how much the sales are, then how much that cost them. So in terms of profits, so when you think about profits, you need to think about the revenue or sales minus cost. That give you how much profit. Okay, so you can calculate that because the revenue that's from sales, the cost that anything that cost them or any cost they had to pay to produce this amount or to be able to produce this, which whatever, like how much ever they sold that for. So let me just think about, let me do that. So let's say first firm, so how much profit they make. So firm one, they made, they sold silver for 300,000. So that is the revenue minus how much that cost them. They paid 200 to their workers, which makes their profit 100,000 pounds. Okay. For firm two, let's see how much firm two made. So they sold silver necklaces for 1 million pounds. And to produce those necklaces or these silver necklaces, they had to buy silver for 300. So you take that away because this is a cost. And also they had to pay workers 250. And that means now, so how much that would be? Anyone is following? Okay, so that should be 450. Okay, great. So I see people following and putting their answers. So I'm just keeping an eye on Yes, that's perfect. So it's 450. So 450 here means now if we add these together, okay. So again, this is how we calculate GDP according to the income approach. So basically, these two components here, these two lines here, just show the profits. So these are the profits in both firms. So this is profits. So we just calculated profits. So these are profits, and these are wages. So when you add these up together, 450 plus 450, that's 900 plus 1, that's 1,000 or 1 million pounds. So that's the value of GDP in this economy. Okay, so you see, so it doesn't matter which approach you followed. So basically, the idea here is that if there are no measurement errors or no omissions at all, then you should end up with the same calculation for GDP, no matter which method you have followed. So that's basically the first question. I'm going to pause for a second and take your questions. Do you have any questions, guys? Any questions, guys? Okay, great. No questions. That's good. So let's move on to the second question then. So hopefully now we understand how to calculate GDP in different, using different methods. Okay, so the next question. Just trying to clean everything here so we can have more space. Okay, so the next question, we have an economy that produces goods, and these goods are cars, computers, oranges, and oil. And we have data about the quantities and prices of these products in 2006 and 2007. We want to use this information to calculate the nominal GDP, okay? And this is something, a concept I also discussed in one of the recorded videos. Basically, the difference between nominal GDP and real GDP. So, but let me just explain this point briefly. So when we talk about what GDP is, we say it's the value of goods and services. And any value, to calculate any value, that means you need to look at two things, okay? So you need to look at the quantity, okay, multiplied by the price. That's how the value is, okay? And for this outcome here, for this to change or to increase, that could be, if for this to increase, okay, for this value to increase, that could be because Q, or the quantity, has increased, or because the price has increased, or because of both, okay? So with nominal GDP, we can't tell really, because it could be quantity, it could be prices, it could be both. As an example of this, let's look at the data we have. So in this data, let's say we're going to look at 2006, okay? So I want to calculate the total value of GDP in this economy, which produces only 4 products: cars, computers, oranges, and oil. So all what I need to do is to find Q times P, or times price. So we have 10 cars times 2,000 each, plus we have 4 computers times 1,000 each, 1,000 pound each, and again 1,000 oranges times 1 pound, and finally 15, that's the oil, and that's times 1,500. Okay, so when you sum these together, so this should give us, because we use the prices of, you see, these are the prices from 2006. That's why this is called, these are current prices, which means that is what we have here is the nominal GDP. Okay, why? Because we're using current prices. Okay, so I use current prices. I use the prices from 2006. So how much that would be? Can anyone calculate that for us, please? Okay, so that should be, so the total here should be 47,500 pound, of course. Okay, so that is the value of GDP in 2007. So how about if we do this the same for 2007? Well, it is very straightforward. All what we need to do here is to use the quantities and prices in 2007, and that's exactly what or that's how you can calculate the nominal GDP in 2007. So we have 12 cars times that's 3,000 each, plus we have 6 computers times 1,200, plus we have 1,000 oranges times £1, and then 18 times 1,300. Okay, so when we add these up together, then we should get 67,600. Okay, so what does that tell us? Okay, look at this, guys. So we have GDP in 2006 was 47,500, and that has increased in 2007 to 67,600. Okay, the question here: where does this increase? Where did this increase come from? Okay, so as I said before, that could be because of change or increase in quantities or increase in prices. So let's look at the situation we have here. Looking at the data in 2007, we'll see, okay, the quantity of cars increased, the quantity of computer increased, the quantity of oranges remained the same, the quantity of oil increased. Looking at the prices, you'll see changes as well. So the price of cars increased, the price of computers increased, the prices of oranges remained the same, the prices of oil actually dropped. Okay, so what we see here, this change is actually due to a combination of both the price and the quantity. And that's why when we look at the change in output, or the looking at GDP as a measure of how much output we produce, we are interested in not nominal GDP, not the increases in prices. We actually interested in the increases in output. So we want to know how much output has increased. So let me, before I move to this point and show you how to calculate real GDP, let's calculate the growth rate. Okay, so how to calculate the growth rate in this case? So growth rate for nominal GDP. So any growth rate will be the value in time t minus the value on time t minus 1 divided by the value of time t minus 1. So in our case here, if we want to calculate economic growth in 2007, we would basically or simply say, okay, so that would be GDP in 2007 minus that's 2007 minus GDP in 2006, that's divided by GDP in 2006. Okay, so that means that should be 67,600 minus 47,500 divided by 47,500. Okay, and that should give us 0.42 or 42%. Okay, going back to my point, that 42%, is it good news? Does that mean we produce now more than last year? Like the production has increased by 42%? No, that's not true, because part of this increase is mainly due to the change in prices. So what we have here, yes, output has increased. Well, not for all products, though. So it has increased for all products. I mean, oranges didn't change. However, the prices also have increased. Okay, I mean, mostly for most products, for cars and computers, and dropped for oil. So the idea here now, if I wanted to know how much output has changed, then I need to think of a way to exclude the effect of prices. And in this case, which means in this case, we calculate real GDP instead of nominal GDP. So with nominal GDP, remember, we use current prices. Remember, with nominal GDP, we need to use current prices, okay? So in 2006, I used the quantities of 2006 and the prices of 2006. In 2007, I used the quantities from 2007 and the prices from 2007. But now, because I really want to know how much real GDP, real output have changed, so then I need to exclude the effect of prices. So in that case, you need something called the base year. So I need to fix the prices according to that base year. So let's say that our base year will be 2006, okay? So in that case, if I want to calculate how much GDP has changed, or real GDP has changed from 2006 and 2007, then I need to exclude the effect of price changes. So I need to change these prices. Instead of these prices, I need to use the prices of 2006. Okay, so the prices from 2006. So in that case, I'm going to use the quantities times the prices of 2006. So instead of this, I'm going to multiply 12 by 2006 by 1000, 1000 by 1. It's exactly the same from last year, and then 1500 for oil. Okay, so that should give me the real. Can you please calculate that for me? Can anyone calculate how much that would be? Okay, see how many people are following still with me. Okay, so how much would that be?
58,000.
58,000. Yes, that's right. Okay, so if I remember that correctly, yes, that should be around that number. So, okay, so that should be 58,000. Okay. Oh, so what's happened here? Let's see what's happened here. So this is the nominal GDP. So the first number here is the nominal GDP, where I use the quantities and the prices, current prices. Okay, but now I actually fixed the prices. So I used the prices of 2006. Okay, and just remember, we call this the base year. Okay, so the year that you use the prices of that year is called the base year, because this, if you calculate real GDP in 2008, 2009, then you need to be consistent. If you fix the prices of 1 year, then you need, if you want to make a meaningful comparison, then you need to fix the prices for the whole series now, just to see how much output changed. So let's go back to the example. So what we have here, real GDP now actually is 58,000. So it's not 67,600. Okay, so now the question to you, what is the real GDP in 2006? The number we see on the screen now, the 58,000, is the real GDP for 2007. So my question to you, and you have 2 seconds to answer, what is the real GDP for 2006? I'm going to look at the answers. Okay, perfect. Great. So, okay, so everyone is telling us that that's right. It's 47. So real GDP in 2006 now is going to be the same as nominal prices. Why is that the case? Why is that, guys? Those who answered correctly, of course. Why is that the case? Why the nominal GDP is the same as the real GDP in 2006?
Because we fixed the price at 2000 prices, so it's the same.
Yes, perfect. Thank you. That's exactly why. So okay, so always then remember that the nominal GDP and real GDP that will be the same figure on in the base year. Okay, so because using basically the same prices. Okay, and if you remember from the videos I recorded, one of the videos I show a graph of the of both nominal GDP and real GDP from the US over a few decades. I think it was started from 1960. Okay, it was clear that both lines, nominal, of course, there was an upward trend in both, which means the economy, or the US economy, has been growing as well, so been producing more every year. But then the idea is that these two lines, the real GDP and the nominal GDP, they crossed at one point, and that point was 2009. And the only reason for that is that because we used 2009 as the base year when we calculated real GDP. Okay, so if it happened that you have used a different year, then the lines, both lines, would cross at that point. Okay, not at 2009. So the only reason, as I said, that these two lines crossed at 2009 is just because we're using 2009 as a base year to calculate the real GDP. In other words, we're using the prices of 2009 to calculate the value of GDP for other years. And that is again for making meaningful comparisons. And we would know now what happened to real output. That's what we care about mainly when we look at whether the economy is growing or not. We basically want to know how much output has changed over the years, and that will tell us about the situation in the economy. We're producing more, producing less, and that is the idea. So we produce more, that means the economy is growing. Producing less, that means the economy is not growing. So basically, that's the growth rate again. So so how would we calculate the growth rate then for real GDP? Okay. Okay, perfect. So that's right. So so real GDP here, the growth rate of real GDP, basically you're just going to use these two values here. So it's going to be 58,000, okay, minus 500 divided by 47,500. That growth rate, okay, would give you the exact or the true picture about output. Okay, so when you look at the nominal GDP, the economy, according to the nominal GDP, has grown by 42%. That's amazing, or 0.42. But then when you actually look at how much actually the economy has grown, it's actually it's more about the output, how much more we produce this year. Just going back to one of the questions in the chat books, no, current doesn't mean constant. Constant means that I'm just not going to change the prices every year when I change the when I calculate the GDP. Current means every year, which is to do with nominal, so that's related to the nominal. So if you use current prices every year. So when I calculate the GDP in 2006, just going to use different color. That's not great color. It's white on white, so you can't see that. So when I calculated the GDP for 2006, I use current prices, means the prices of 2006. When I calculate the GDP for 2007, again, current prices means using the prices of 2007. Okay, so from the current year. Okay. The idea of keeping the prices constant, it's more to do with calculating the real GDP. I want to know how much output for the real output, how much that changed over time. And our example here between 2006 and 2007. And if you get this right, if you understand this from here, this could be applied on any number of series. You could be looking at decades. Okay, so the idea is that just fixing the prices. So every year I'm going to calculate the GDP based on the prices of 2006, and that makes 2006 is my base year. So I'm basing all calculation based on the prices on 2006, and that's how I fix the prices. Okay, so the prices were not fixed at all over that time. During that period, the prices have been changing, going up and down. But because my objective here, what I want to do here is to know how much output has changed, I need to exclude the effect of prices. And one easy way to do that is just fixing the prices. Just assume prices have not changed and try to sorry about that, and try to calculate the real GDP. That will give you how much output has changed over that time period. Okay, so this is hopefully that makes the point clear. Okay, I'm going to stop the recording now, and I'm going to take more questions.